Hello students and welcome back to one more session of tourism finance classes. So in our yesterday's class we were talking about venture capital financing methods, that is a different ways of financing a venture capital which include equity, conditional loans, quasi equity and income notes. So equity is where you are becoming the owner of the company. So it is allowed up to 49%. Conventional loan is a loan where you don't have to pay interest, but after the firm starts selling and earning revenue, you have to pay royalty as a percentage of the profit. Third is quasi equity, where it is a hybrid between equity and debt. So like equity, it is unsecured, but by like that you have to pay interest. And lastly, income notes, which is a hybrid of conventional loan and conditional loan. That is, it will get interest as well as royalty, and you have to pay back once the company start making revenue. So those were the methods of financing venture capital. In today's class, we'll talk about how a venture capitalist can exit from that business. I told you before that a venture capitalist invests in a business where there are high profit volumes, but gestation period is high, makes some amount of profit, and at the end quits or sells his stake and take his amount back and invest in another business. So always in a venture capital, there is an exit option where you can take back your money and exit, and also give them advice about how to sell it. So first thing here is initial public offering or IPO. Say you have started a company and for a couple of years you have run it very well. It was a privately owned company by the venture capitalist and some loans taken from outside. And so it was only, the management and the ownership was to limited people. Now, once the venture capitalist thinks of exiting from his business, he can use IPO, which is a process where a private limited company will go public, means it will issue its stocks in the stock exchange and sell it to general public, so that more and more shareholders are there and the venture capitalist can take back his money. So when you're doing it for the first time, so your private is was owned only by few people within your friends and your sponsors or financiers. Now you're selling it to general public and it is done for first time. So we call it as initial public offering. So it could be a new or young company or an old company, but which was not gone public. Say for example, IPO of Maruti just happened a couple of years back. Then Infosys went public and had made its IPO in 1981. So on. So a privately held company, after when it wants huge funds for expansion and the initial promoters and venture capitalists are not interested in pouring up new funds, they go for public offering for the first time, wherein the company is listed in the stock exchange and the stocks and shares are sold to the general public. Next type of exit option which a venture capitalist uses is called as a trade sale. A trade sale is a sale of a part of sale of a business to another business, and which is a common form of exit option. Here, the acquiring company normally acquires the intellectual property rights owned by the previous company, or to capture the market, the share of the company it is purchasing. So trade sale is similar, or you can say it is one and the same. Acquiring a foreign, acquiring when you are acquiring a new company, it is wholly acquired. But in trade sale, it can be part of business also, means only partly half of the company or maybe one unit or one branch is acquired. So you're selling one unit to another so that you will get funds and you will get extra knowledge and thereby exit from the venture capitalist. Okay, so then the next one here I told you is promoter buyback. Now promoter means the person who had the idea of doing that business. So that product or that company was his own brainchild. As he was not having funds, he has taken the help of venture capitalist and bought back and raised this company. So now when the venture capitalist wants to exit from that business and wants his money back, the promoter, the person who had started the idea of business, can buy it back from the venture capitalist and make his own single company. Okay, so once after a lapse of a few years, revenue is generated and he's making sufficient funds. So he has the option to buy it back from the venture capital and make it his own company. So this is called as promoter buyback, where the idea owner or idea generator is, when in the initial years having lack of funds, couldn't be the owner of the company. Now he becomes the fully owner of the company. And the fourth option is acquisition by another company. Here, you may say that trade sale and acquisition are one and the same, but in trade sale, even you can acquire part of the company. Here, you are selling your company to existing some other company and taking these funds and investing in another business idea. So a person with new ideas and with having sufficient venture capitalists, they do this by investing in one profitable venture, doing the business there, reaping profits, and then selling it to another company. The selling may be because you just want to go out and do something new, or maybe you are having shortage of funds. So or you can't manage that company. So that is acquisition by another company. So these are the exit options of venture capital. So I hope you understood this. These are the four exit options where the venture capitalist will back off or go out. So in all these cases, the venture capitalist will give the necessary advice, the procedure, how it has to be done, how smoothly to be done. All those advice is given by the venture capitalist, because he is not only the financer of the company, but also he is giving necessary experience, having necessary experience in this business before. So he will give you all those ideas about how to go public, how to sell it, and so on. So this is all about the exit options of venture capital financing. So that's all for today. Have a good day.